just start off with a quick introduction to what to expect today. We're aiming to run for about 45 minutes, so end at around 11:15. I'll give a quick intro to CoolCare, who we are, why we're hosting this webinar today, and we'll move swiftly on to Richard and his contribution, introducing Christian Co. and talking us through that key topic of valuing your care business and preparing for growth. So he'll give us some fantastic insights into the health of the market, what the care sector buyers and investors are looking for in 2025, and some of the valuation metrics that you want to have in mind as you're growing your business. And then we'll move on to a Q&A. I've got a few questions prepared for Richard, but I'd love as many questions as we can get from the audience. You should have access to a Q&A feature. So throughout, if a question comes up, pop it in the chat and we'll come back to it at the end. And if it's answered midway through, we'll kind of cover that off. So I've lost my mouse. Without further ado, I'll just give a brief introduction to CoolCare. For those of you who don't know us, I know we have some CoolCare customers on it as well. CoolCare are care home administration software providers. Our purpose, the reason we are in existence, is to make operating care homes easier, more efficient and more profitable. We are part of the L&T Care Developments group of businesses. So our sister companies build care homes. They're the largest producer of care homes in the UK, and they also operate care homes. We've been making care home software now for over 3 decades. We are older than Google, probably one of the first to make care home software, but we see ourselves as quite different from other software providers in that we are care home operators first and foremost, and so we really understand what it takes to run a successful care business. A few interesting insights that I think relate to today's topic and why this is something that CoolCare is so interested to discuss. Had a quick look, we get a lot of site extensions. We've got about 65,000 care beds on CoolCare at the moment, and we get a lot of organic growth from our current customers expanding. And across the last 18 months to 24 months, we've actually had 20% of our customers who have added to their portfolio. And on average, CoolCare customers are achieving 11% above the national average in weekly fees, with high levels of occupancy and higher self-funding ratios. So these are businesses that are looking at those key metrics that Richard will discuss later. And so how do we help our customers do that? Well, we say we take the out of your admin, we give you that control back. Got a range of features across all those touch points in your business that you've got to keep your eye on to ensure that you're watching the bottom line, you're helping that growth. So occupancy management, time and attendance, ensuring you've got good staffing, helping reduce things like the use of agency, so decrease in agency usage of 13% over the last few months for our customers, which is helping you to then achieve better margins and also improve your care. So a range of different things that we do. If you're interested in CoolCare, you want to learn a little bit more about how we can support you, my contact details are at the end. But without further ado, I'm going to pass over to Richard.
Thank you, Fiona. Good morning, everybody. Can't see any of you, but my name is Richard Lunn. I'm the Managing Director of Christian Co.'s healthcare team. I've been the Managing Director. I joined Christian Co. in 1989, and I've been the Head of Healthcare since 1999, so over 25 years growing our team. Very proud to have grown what is now the largest team in the UK. Fiona, could you move on to the next slide, please? For those of you who don't know, Christian Co. is a firm of agents, valuers, and analysts. We work with what we call operational real estate across 3 sectors: healthcare, retail, and hospitality. And on average, we see about 40 care home properties a week from our 11 offices across the UK and 11 offices across Europe. Next slide, please. The team is over 47 people across the UK, Germany, and France. And I would hope that many of you will know or have dealt with myself or colleagues over the years. I'm amazed to say that the average tenure of the people in my team is 18 years. So we've got some incredible people who've been involved in the sector, working with operators and developers and investors in specific patches across the UK. And as a result, we transact over 60% of all the individually sold care homes that get sold every year go through our network. So by far the largest team, and we're seeing operators and investors every day of the week, specifically looking at healthcare. Do you want to move on to the next slide, please? I just thought the analysts, obviously, given all the care homes that we inspect and see every week, the analysts pull together financial information. And we just try and look at benchmarks from our own data that we see. Obviously, operators have specific data relating to the types of homes they've got. But some of the averages, I think, obviously, staffing is the key metric for everyone in care. We're a people business. And staffing costs as a percentage of overall turnover, they are up as a percentage, but I think that's been slightly mitigated by significant improvement in fee levels over the last few years. I think particularly where people have got private pay clients, they've been able to leverage off higher inflationary costs and put that through the business. So for most people, that staffing level, staffing cost has been relatively stable, and one of the big improvements has been a significant reduction in agency costs. Clearly, agency impacts every business, but it tends to be in specific homes more so than a wider issue across the whole of the business, where you've lost a manager or have difficulty recruiting in specific homes. But I think from an operator perspective, seeing a big reduction in agency is really positive. Clearly, one of the main issues for us all, for every firm, has been the increase in national insurance from April, and that consigning alongside the increase in national minimum wage is going to cause quite a few difficulties for some operators. But I think that is predominantly being offset by increases in private pay fee, and that's the main position we're seeing. Next slide, please. Here are some wider other costs. You'd see that food costs have remained relatively stable. Utilities are softening from some very significant increases over previous years. And repairs and maintenance, I think there's a clear need for operators to stay on top of their portfolios. We used to see a number of around £1,000 a bed as a sort of litmus test, but now that's much closer to 1,600, maybe £2,000 a bed across quite a lot of the portfolios. Next slide. Yeah, so obviously the main driver for profitability for operators is starting with occupancy, and the positive trend that we're now seeing is that occupancy across the board is up. There's a significant increase from pandemic times, which is great to see. I think the average length of stay in nursing has reduced over time, but actually the demand is there. And there's a particular shortage of dedicated dementia bed spaces, which is driving those occupancy stats. But clearly, as most operators know, care home makes most of its margin when you're through 90% and upwards. So actually having that as an average is a really great position from an industry perspective. Next slide. Yeah, one of the things that obviously drives the marketplace is the age and quality of stock. I'm old enough to remember when the government tried to impose national minimum standards on the sector, and what we've had for the last maybe 20 years, the government tried to impose national minimum standards, and overnight many homes decided to close because they couldn't meet those national minimum standards. So the government did a U-turn and then said that they would only impose those on new build care homes or extensions. So we've had a sort of twin track marketplace where existing facilities have got grandfather rights, and then people have been building assets ahead of those specifications. It's interesting to see from this slide that only 20% has been built over the last 15 years. So it is quite an aging stock and across the UK. And from our perspective, looking at how that stock is improved is a really important factor. Do you want to go on to the next slide? So quite a lot of operators, if they've got an older asset, are having to look at ways in which they can improve both their services and the efficiency processes within their homes through retrofitting of improved installation, heating systems, lighting. Clearly, most of this is much easier when you're starting from scratch and you're building a brand new care home, and therefore there is a big drive to actually build something new to develop facilities that are in a qualitative nature ahead of the marketplace. But if you imagine how the sector has evolved, we've gone from converted assets through to purpose-built, which maybe have had just maybe an ensuite wash hand basin, then improved to ensuite shower facilities, to current facilities being developed with ensuite wet rooms. But I think there's also a greater focus on the improvement of resident and relative experience within the homes as well. So greater provision of cafes, cinema rooms, hairdressing salons, all those kind of things that are now coming through into people's services. The next slide. From our perspective, we've seen that the type of asset being sold is broadly consistent. There's been an increase in the number of smaller homes sold. You'll see from those stats that sort of between 10 and 15% of the homes we sell are less than 20 beds, and quite a few of those actually go out of the elderly market into maybe repositioned into learning disability services or other care services. There's a greater growth of sales occurring in the sort of 20 to 40 bed range, and that's predominantly an increase in the profile of operators that have got sort of 2 to 4 homes, but I'll come on to that on a different slide. There's a piece there below which shows completions as a percentage of asking price. I think that's my colleagues just showing that they know the market and they're able to try and price assets correctly. But I think it's as a strategy, trying not to overprice and actually getting some competitive interest in a care home is a really important way in which to achieve the best price. We have the next slide. Sorry, if you can go back one, you went forward to. Here we've got the buyer type, and you can see there that actually the independents, people with only 1 or 2 homes, actually makes up a significant proportion of the buyer profile. We still have first-time buyers. I think in my mind, first-time buyers used to be just someone who's buying a small care home as their first entry into the marketplace. But I don't think the first-time buyer is necessarily someone who's just buying a very small care home to start off. Quite often we have people from other industries that see this as a sector that they're very keen to get involved in. We've just completed a sale of a 60-bed home for someone who developed an incredibly large portfolio of student housing and actually wants to get involved in this sector. And we've sold him and his family their first care home, and they'll start to grow that portfolio and try and do the similar sort of thing. So there are new entrants. Clearly, I think the barriers for entry as an industry are much greater than they are in many others, and that's a defensive play that the sector has. There's been massive activity in the small and medium groups, 3 to 19 homes, maybe up to 25 homes. I think the larger operators have tended to do most of their growth through development of new assets, brand new assets, rather than actually buying lots of portfolios. So there's been fewer portfolio transactions of the major providers buying out other providers, and their growth has been driven by development. Next slide. Obviously, I keep an eye on how long deals take. We have a period of marketing before we actually get an offer on an asset, and you'll see from these stats that we market homes either as an asset sale, so we're selling just the real estate and the operational business, or selling the limited company. When you sell a limited company, you tend to exchange and complete it simultaneously, so you don't have a bit of a period between an exchange of contracts and completion. But historically, an asset sale, we would agree a deal, get to exchange, the application is submitted for re-registration, and then complete upon re-registration with the regulator. You see that normally takes 5 to 6 months. That timeline is going out, and I think there's two things. Obviously, the regulator is taking much longer in which to actually conclude the transaction, but I think also just getting the deal done, the level of diligence that's required these days to comply with funders, to fully understand the business, to get the business across the line, takes significantly longer. And actually, in 2024, we went from sort of an average of 6 months to 7.5. For the first 4 months of this year, we're at 8.4 months. And my forward-looking number is closer to 10 to 12 months. So it's taking a lot longer period. So we're getting people to try and submit their application for re-registration and run that concurrently with the legals in terms of trying to transfer the sale. Next slide. Just, I think some of the key points when people are looking to buy, they're pretty obvious, but the CQC rating, I think, has a big bearing. Ironically, an outstanding asset, whilst it's trading outstanding, many operators are concerned that can they continue to maintain that? How easily will it be to maintain that outstanding registration? Where will the business go? So vast majority, I think the transactions tend to be in that sort of middle period of rating of good and requires improvement. When assets are inadequate, that becomes also quite a challenge in terms of transferring the registration during that process. And it tends to be a bit of a white knight purchaser, and we're working with the regulator and the commissioners to transfer that service. But the vast majority tend to be in the middle market where someone could see their opportunity to grow or improve services and improve profitability. Profitability, it obviously varies hugely depending on the type of asset, the kind of service being operated, and the fees charged. And we see anything from assets not trading at a profitable at all through to stuff that makes 35 to 40,000 pounds a bed EBITDA in a private pay, high quality, purpose built asset. So, but all of those points are really important when people are assessing transactions. And clearly the asset quality is super important in terms of how people arrive at what businesses are worth. Room sizes, the longevity of that asset, the quality of the provision, day space, and opportunity to grow or extend. Next slide, please. The $64 million question, everyone wants to know, what's my business worth? And I think the answer is always, it's a multiple of what. Is it of historic performance? Is it of current performance? Is it of future performance? The same asset, when you deconstruct that sale price, if you take those three metrics, will come up with a different number. But the average on many sales is sort of between 5 and 8 times EBITDA, or just in net profit. I think for the higher quality, newer assets that we call prime, super purpose built, then the multiples are 8 to double digit, given that actually the way those assets are transacted, we might sell away the real estate to a real estate fund, create an operational business, an OpCo that's leasehold, and then actually sell the leasehold operational business on top of that. So when you split away the real estate at an exciting yield and then get a multiple on OpCo, you're getting double digit values. But that really only tends to be on the newer private pay assets. If I'm honest, there's very little evidence of hugely significant OpCo value in older assets at this point, but clearly there is value in OpCo. From our perspective, we're looking at the asset quality, as we said before, the regulatory rating, looking at the maintainable trend of performance, and looking at it from a comparable evidence. So, we sell over 200 care homes every year. Interestingly, this year we've already sold 110. The market is really strong. There's been a lot of activity. And in the first 4 months, we've sold 110 assets. So given all the headwinds that we see across the sector, there is still a lot of people looking to buy. Can we go to the next slide, please? We'll sort of just talk about a couple of the bigger transactions. And I think one of the things that we look at as a business, everyone talks about a multiple of earnings as a way to value, but actually one of the key things that Christian Co does is look at the sum of the parts. What are each of the individual assets worth within that portfolio? And I think a lot of the major organizations have been asset managing their businesses, and quite a few homes will be non-core. That may be because they are geographically outliers. It may be that the operational performance is not brilliant, and they've got to spend too much management time on each of those individual assets. And for us, if you've got an organization that may be valued at 10 times EBITDA, if you've got a care home that's losing £200,000 at an operational level, on a balance sheet, that's got a negative value of minus £2 million to the balance sheet. We will then sell that out privately to an individual operator that will look at that home and think, actually, I've got two other homes locally. I can add value. I can sort out the issues there. I'll visit the home on a weekly basis. I'll turn that around. And actually, the underlying real estate is worth significantly more than that. So we might then sell that asset for £2 million, even though it's losing money. The opportunity for the purchaser is that they'll turn that around significantly and enhance value. But from the seller's perspective, they've got a balance sheet swing of from minus £2 million to actually a capital receipt of plus 2 million. So there's a 4 million balance sheet swing. So a lot of the bigger operators are actually thinking about that. And we've been working with them and selling those assets out into the regional and national marketplace. I think the biggest project we've done to date is Four Seasons Healthcare, where we launched 111 care homes in 2022. Many of the people on the call will have looked at those assets. We did over 1,000 viewings. The whole team were involved, showing operators around. And we sold 65 of those homes in 48 transactions. Four Seasons then decided to take back and hold on to about 45 of the homes. Ironically, we've just acquired those in a separate process for an investor that's bought those homes, and will have put them out into to their operational tenants. We've worked with people like HC1 to again shape their portfolio and to sell those out into the wider market. And I put a couple of other key sort of transactions over the last year or so. We sold Halcyon, which was an OPCO, purpose-built OPCO, which was sold on a leasehold-only basis. Sold 03 care homes, which is quite a large learning disability portfolio, to private equity. We facilitated the merger of Fremantle Trust in Buckinghamshire, which was a not-for-profit care home provider, into the Orders of St John Care Trust. And then we've been working with MHA, Bupa, and Larchwood to do exactly what I've been talking about, selling out some of those individual assets into the wider care marketplace. And I think for me, the response to those assets has been huge from regional and individual operators looking to grow. So yeah, I think we're selling everything from individual home operator care homes through to some of the largest transactions that have occurred in the UK market. Next slide. At the end of every year, we try and ask the operators for their sentiment going into 2025. And I think you think about the noise that was there. I don't know if everyone can see that slide on the left-hand side. This was in sort of November time, asking about 2025 and their sentiment. About 30% positive, 30% neutral, 39% negative. So actually, quite a lot of people, a lot of concerns going into this year. Very few people looking to sell. Ironically, they may have concerns. 41% neither buy or sell, 32% looking to buy. I think what we've actually seen is there's been huge activity. There's a lot of operators looking to grow, looking at this as a sector that they want to be involved in. And we've had a fantastic start to the year, one of the most amazing starts that we've had since 2007-8. So over 110 homes transacted so far. Greater involvement from American REITs, which are the real estate investment trusts that fund the purchase of the real estate and then create a leasehold business. And lots of the sort of regional, multiple or medium-sized corporate operators are expanding their portfolios using sale and leaseback financing funded by REITs, both UK and international. I said earlier, we do get still continued first-time buyer interest. And I think for me, there's a couple of other points there. Staffing costs, clearly one of the major issues. Actually getting staffing and retention remains one of the biggest challenges for operators. but that's been offset by ability to increase fees. I think the final point, I'm lucky enough to go to America 2 or 3 times a year, go and meet the US operators and US investors. They all get together and I go to their conference. And I was in California recently, and one of the slides was put up. As long as I've been in the industry, we've talked about the demographic wave that's coming through that will drive the needs of this sector. And there was a slide that was put up that showed that the baby boomers, the post-war generation, they turn 85 this year. And that's the start of that boom generation that will require care. And the stats were showing that the 85 plus generation increases between 6 and 8% every year now, all the way through to 2040 when it starts to level out. That boomer generation coming through. So for me, I think that's a quite exciting piece, that the demand side of the equation is here. The qualitative nature of what we then provide as operators is super important. But actually, when you've got demand, you can then invest in provision. But it looks like we've got the start of what should be a very positive period if we can control the other pieces around costs and staffing, and make the sector even more exciting. That's me.
Thank you so much, Richard. That was fascinating. I'm going to open up for Q&A now, and just so you know, we will be sharing this recording afterwards, so you'll get this mailed out to you if you want to go back and look at anything that Richard has said. I find I'm going to kick the Q&A off with my first question. I think it's fascinating looking at the sentiment, as you say at the end, it looks a little bit negative going into 2025, but then the amount of transactions that you've seen, there was obviously a lot of concern around NICs and the impact of that on the sector. Why do you think that that's maybe not having such an impact as first anticipated?
I mean, occupancy is strong across the sector, so that helps operational performance of businesses. I think no one wanted or is happy about the increase in national insurance. All businesses, we did our own budgets and had to find, a huge sum of money to actually meet that increase ourselves. But I think it's probably been people having to offset it or absorb it. And I think if you're local authority funded only, then you're going to see a margin squeeze, and that will cause a lot more difficulties for operators that have not got the ability to be able to pass on those increased costs. But as we said, the margin is there in a care businesses when full and operating well, make very decent money. So the ability for operators to actually absorb it is there. No one likes to do that. But if you haven't got that balance between occupancy, ability to pass on the cost, then you will see significant margin squeeze, and those businesses will be the ones that will find more difficulty.
What are investors typically looking for then in terms of MI to give that confidence around occupancy?
I mean, everyone wants to see information. I mean, we live in a society where data is super important, and I think internally we have an analytics team that are looking at everything on every transaction. Provision of information is super important, and being timely and current information is super important for people to make decisions. I think a lot of operators who've been in their businesses for many, many years and haven't got significant debt, it's less of an issue, and they're quite happily running their business, and they don't look at it in the same light as those that are leveraged or have got scale. But actually understanding how your business is operating, being able to challenge management in each of the homes for trends or whatever, I think is key to driving quality businesses.
See some questions coming through. So Rich Dares asks if you could give an insight into what a seller profile looks like.
Yeah, it's interesting, isn't it? We spend our time building a relationship with operators across the UK to try and find that moment when someone wants to sell. I've joked over the years, we call it the 5 Ds, death. You struggle to run your care home when you're dead. So death, divorce, debt when people have got problems, they want to sell their care home. A deal where we actually come along and say we've got someone that would like to buy this. We can see there's a mutual reason why this purchaser would be really keen. Would you sell your business? And then the final one's a bit more tenuous, desire to do something else. People are burnt out. They've been in the business for a long period of time. But I think the profile of I've been lucky to have been working with people. We sold them their first care home 30 years ago. They've created a portfolio. They've retired. They've sold out. But actually, there's a whole generation of second generation family members that actually are professionalizing smaller regional or medium-sized businesses, looking for growth, looking to take on the sector and to actually create a different business to their previous family ownership. And we see that a lot. And actually, that drives people coming out of the market and actually the next wave of operators taking over. But yeah, I mean, my career has gone from dealing with Mr. and Mrs. Individual owner operator to we're now dealing with all across the whole spectrum, from multi-billion, $10 billion, $30 billion real estate investment trusts that are buying the real estate, through to private equity owning the operational businesses, and major corporate organizations with tens of thousands of staff. It's a very much more mature business than it was when I first joined 30 years ago.
When we spoke previously, you made an interesting point about the changing view as well on the sector from an investor point of view and the view on operating assets.
Well, I think historically, from an investment thesis, high street retail or office and resi housing has been core in most investors' portfolios. And they didn't like operational risk. They didn't like having an entity where the operational business could be affected and therefore the value of the real estate affected. But actually, during COVID, I think our high streets have changed dramatically. The internet has taken over. We're all working from home a lot more. We do, people work in the office, but work from home. So actually, offices themselves have had to think about what they do. So actually having operational risk is now actually seen as a positive. So there's a lot more investors that actually like operational risk in a hotel or in a care home. And when you add on board the regulatory piece, which gives you the barrier to entry for care, I think that makes more and more people look at this as a sector. It's a needs-driven, counter-recessionary sector. And when delivered well, is actually, a super important part of what we do. And I think, unfortunately, the public perception of a care is through the press, who only ever want to identify issues. Someone delivering great outcomes or delivering good care is not sexy news, is it? Actually, coming up with a scandal is how the press approach the sector, and that's unfortunate because I think a good care home improves the quality of life for people, gives them it's a really important service. So for me, I think it's something that's only going to grow. The demand for the sector and the professionalization of the sector has just improved over time.
Yeah, we've got some more questions coming in. So someone's asked, some authorities are looking more towards home care. Is there a concern in the care home sector regarding this? And then there's a similar question, though, which is around, not mentioned the dom care sector today, and how is it trending as we're a dom care company and we'd like to expand by acquisition? Any information on moving to dom care? So I guess two sides to that question. How is dom care affecting the care home business, and are there opportunities in dom care?
Yeah, I mean, dom care has been around for many years, and actually in many authorities, it's people would prefer to remain in their own home until they are unable to be looked after. I think there's a place for both. I think clearly staffing is one of the major issues for the sector as a whole. And continuity of staff, it makes it very challenging. And I think some of the local authority contracted rates for dom care are so low that actually delivering that service is a huge challenge. Clearly, when you've got a facility where everyone's in one location and all your staff are arriving, it's operationally much easier to do, but obviously there's a much bigger outlay in capital cost to buy an asset and to to maintain that asset. So I think there's a place for the whole spectrum of care delivery. It's about the qualitative nature always, and there's always activity both in terms of buying and selling of people that want to grow and people that want to move on. So for me, I get to the end of every year and think, okay, that's been a good year or a bad year or whatever it may be. How the hell are we going to do it again next year? But actually, there's always churn. There's always people looking to do something different, and the market's always evolving. But I think the pay or who pays for all this is clearly the biggest question. How it's paid, how it's funded. Those are governments keep kicking it down the track. Clearly pushing more onto the individual to cover our own care costs. And actually, as a result of that, people want quality. If they're paying for it themselves, then there's a drive towards quality. So yeah, I think to answer both of those, there's a need for both.
That kind of leads on to a question by Avnish Goyal, who's asked, how far can private fees go? And what do you think of the London market? Will people pay £5,000 a week when they can buy the care in?
Well, Mr. Gore should know, given the kind of assets that he operates and the length of time that he's been in the sector. But yeah, I mean, I remember we used to get to £1,000 a week as an average fee, and everyone got a nosebleed at £1,000. We're regularly seeing care home providers with fees at 1750, 1850, £2,000 a week. Clearly, super prime assets in great locations where they can command those kind of fees are possible. But it does, as Avnish has just suggested there, people, if you're spending £5,000 a week, the kind of care you may be able to purchase in or maybe much easier to arrange than actually get a whole home full of people paying £5,000 a week. But yeah, who knows where fees will go? I think we've seen significant increase in private pay fees over the last 2 years. Most operators put their fees up between 10 and 12% annually for the last couple of years. So that's significantly helped move the dial in terms of where the average fee sits.
Another question is more of a techie based one, but on this kind of the affordability point and what people will choose from care. So Richard Burden's asked, what do you anticipate the effect will be of being able to purchase your own care robot at an affordable price on the number of care home places? And I think this is interesting as well. We look at the changing expectations of the market that's coming through now, and as you said, that the baby boomers being the next care home.
Yeah, I suppose we all think, how is tech going to impact on every industry? I'm not sure I've not seen care robots and how effective they are at this moment in time. And we are a people industry, aren't we?
Yeah.
My neighbour's got a robotic lawnmower that goes day in, day out and keeps it trimmed. And he's quite happy with that. So I think there's always developments that will do it. But I'm not sure how you replace the empathy, care, and love that individuals can give each other with a robot. But can tech enhance the service and performance? Absolutely. But I still see this as a human to human business.
Yeah. I think there's some things that you don't base purely on cost, and it goes down to value. If you're looking for care for a loved one, I think yes, there might be a cheaper alternative, but are they going to be cared for in the same way? And I think from a tech provider, one of my pet peeves is the jump to futuristic technology that isn't here yet. And it's not really the purpose, as you say, of technology. Technology should be assistive. It shouldn't replace things that are purely human. It should replace the things that are, can be automated, can be machine driven. And I think in care, there is probably going to be, it's one of the few industries really where there is a bit of a line on that. And probably is actually more of an opportunity for care compared to other sectors that can be more automated.
I've been in real estate all my life, all my career. And when my grandma went into a care home, I've been in hundreds and hundreds of care homes. And when she went into the care home, I hardly looked at the building. I suddenly realized I actually was looking at the staff, and I looked at how they interacted with her and how they spoke to me and how they spoke to and looked after my grandma. And I didn't look for all the other things that I look at every day, which are the en-suites and all the, the nice curtains and all the other bits. I looked at the people. I became a user. I became someone and I saw it from a totally different perspective. And I think that still is the key point to what we do. It's a people industry.
Yeah, and I think that's when we kind of doing training around occupancy and inquiry management, it's something that we often talk about is, it's not the building, it's not the show around, it's how you handle that first call, and training people that you've got to show them that level of care that they're going to receive in the care home. This is not, sales. It is because you're trying to encourage someone to move in. But actually, the biggest thing you need to show is your human side, and the technology is there to kind of support you in taking the notes. So when you speak to them again, you can easily recall the things that you've discussed. You can signpost them to events that are relevant to their interests. But as you say, it's that human element in it that is so important, and all the technology and the asset should be there to enable that to be really easy and as high quality as possible.
And the best operators enhance all of those other bits. They provide all the right facilities, the right equipment, the right training to deliver the right outcomes. And that's where a great business delivers on all of those things.
Few more minutes. So again, we're getting loads of questions coming in. What are realistic buyers multiples for profitable opcos in properties under 15 years old?
So there's been probably 5 or 6 major transactions on opco. If you think about sort of the lot of the major operators are now just leasehold only. They've sold away their real estate and they're pure opco. Somewhere between 4 and 7 times EBITDA. So when you take the fact that you've actually sold away the real estate, if we were selling individual care homes at anywhere between, I don't know, 6 and 8 times, and then you're selling the opco on a similar sort of multiples, you can see how that goes to value. But they are really only on the newer higher quality assets because you've got longevity, you've got something which people can raise capital against. But there's been very few transactions that have actually occurred on an opco only basis. But actually, in our other sectors, childcare, dental, all of those kind of businesses are predominantly leasehold. They actually don't own the real estate. And we get significant multiples on those kind of businesses. So it's only care where it seems to be slower for us to actually get the opco transactions. But we've done more over the last 3 or 4 years. We sold a small opco and in the southwest for 5 times earlier in the year, and we sold Halcyon as a larger portfolio, which was actually sold to a not for profit. But I think it's the reason that organisations want to buy quality opcos. It's adding the qualitative nature to their own portfolios, and actually the capital required to build a brand new care home, find the land, build it, fill it. That's a 4 to 5 year process. So actually getting something that's up and running, already delivering profitability post rent, it's a much easier way for organisations to grow.
I'm thinking one last question because this is an interesting one. So how do you see investment in future-proofing care come through in terms of the cost of digitizing and carbon reduction, the significant costs, and how do they impact on sales and purchases? And have you seen a change in valuations for those who have invested?
I think what people are doing there is future-proofing their assets, and actually for some of the major funds, the ESG requirements, the improvement in EPC rating, all those kind of things go to value. I think the challenge for us collectively is that investment funds are linked to their yield that they pay is dramatically linked to interest rates. And so the ability for them to pay much sharper yields when interest rates remain relatively constant is just not there. Their cost of capital doesn't reduce, so they can't pay more aggressive yields. So we probably haven't seen the benefit of those significant improvements in asset quality. But lots of the funds won't buy assets that are not going to comply in the future. So your purchaser profile will change if you've not done that kind of work. So it is a challenge. I think there's not an immediate return for everyone at this moment in time, but I think in a over a longer period of time, it will give longevity, and it will go to value.
I know from a digital perspective, we've spoken with some REITs that will only invest if the OpCo has got good digital systems in place.
Yeah. I mean, you've got to have that. That's taken as read. You've got to have that.
We're 1 minute over. We've got more questions. I'm sorry we can't answer them all, but that's been fantastic. Thank you so much, Richard, for your time. Thank you to everyone that's attended. We will circulate.
If people have got further questions, I think our email's on the bottom there. If people want to give us either of us a call, then I'll happily pick up. I would hope that the people around the country know the rest of my team. If they don't, our emails are on the website, and we can pick up directly with everyone.
Thank you.